Hello, Carissa Dorado here from Premium Mortgage. I'm a mortgage loan officer, and today we're going to be talking about credit score factors. This is actually something that I get asked quite often during the mortgage process and even leading up to the pre-approval are what are the factors that go into my credit score and how do I have the best credit score when it is time to have that credit report pulled. So the biggest thing is 35%, and that's your payment history. So how have you paid your bills in the past 12 months, the past 24 months, and it goes all the way back to the last 7 years. So making sure that you don't leave this up to chance, please make sure that you have a checklist that you utilize. We want to make sure that if for some reason you don't get a statement in the mail, that payment still gets made. So make sure that you have a backup plan, making sure you pay that bill every single month and make sure that it's on time. The next thing is credit utilization, and that's where 30% of your credit score, and this is where folks tend to have the most amount of questions. So credit utilization is your credit limit compared to your balance on that credit card. So a good example is, let's say you have a $1,000 credit limit and you'd have a $300 balance. That's a 30% utilization ratio, which is actually pretty close to ideal. I'd love to see you in the 10 to 20% range for the best credit score, and really 2 to 3 credit cards tends to what we recommended would be the maximum that you should have for the most ideal credit score. But if you do have any accounts open with a zero balance, actually ask that you leave them open and don't actively close them. You can have the servicer close them for you, but I don't want you actively to close it out because it can impact the length of credit history. So 30% credit utilization, making sure that you have really low balances compared to your credit limit, making sure that you don't actively lower your credit limits. So if it's going to happen, have them do it, not you do it. So next is the 15%, and that's the length of credit history. So if you are going to go into a relationship, you want to make sure that it's going to be a long-term relationship with credit card company, auto loans, things like that. You want to make sure that you're not bouncing around between different credit card companies, often trying to chase the transfer, like 0% transfer, things like that. If you're going to go into a credit card relationship or relationship with any lender, making sure that it's going to be a company that you're going to be working with for the long term. You don't want to have too many new credit inquiries, and you want to make sure that your length of credit history is as long as possible. The next is types of credit in use, and this is installment and revolving. They like to see a healthy mix of maybe 1 or 2 installments and 2 or 3 revolvings. So installment's going to be things where the payment stays the same every single month. So a good example would be student loans, auto loans, and maybe an existing mortgage payment. And then having that 2 to 3 credit cards, and that's going to help you with the types of credit in use and having that good mix. The last 10% is new credit. So every credit inquiry could have an impact on your credit score. So you want to be really careful about who's looking at your credit report and how often they are. Just know that when you actively look at your credit report through Credit Karma, MyFICO, or maybe you have a credit card company that monitors that for you, that is you looking at your credit report, and that does not have a negative impact on your score. But when a lender pulls your report, that could have an impact on your credit score. You want to be careful around the holiday season where you're getting offers for different companies to go with them, and they'll give you like a 20% discount. If you end up going to 3 or 4 stores and opening up 3 to 4 new credit cards, it could have a really big impact on your credit score in a negative way. And then you're also negatively impacting the length of credit history as well. So just be really careful about the new credit, and also making sure that you go into a relationship for a long term with any credit card or like auto loan company that you might want to work with. So just to do a quick recap, 35% is your payment history, pay your bills on time every single month, have that backup plan. Next is having really, really low payment or balances compared to your credit limits. This is your credit utilization. This is usually the area where I can see folks have a biggest impact on raising their credit score. Next is length of credit history, going into a credit card relationship for the long term, not bouncing around. Types of credit, making sure that you have a healthy mix of installment and revolving. And then new credit, just be careful about how often people are looking at your credit report. And then just know that every credit inquiry will stay on your credit report for 24 months. And anytime you look at your credit through Credit Karma or those other websites that I mentioned, just know that that does not have an impact on your score, because that's you looking at your credit report, not a lender looking at it to give you credit. Thank you so much for your time. If you have any questions, feel free to reach out to me via email or cell phone, and I'd be happy to explore how to bump up the credit score before we pull for a pre-approval, or just some general information to help set you on your way for a good, healthy credit score. It has an impact on a lot of different things, more than just your mortgage. Thank you so much for your time. I hope you have a great day.